Here's something most investors don't think about until it's too late. You can do everything right, build a solid portfolio, make smart decisions, time a sale well, and then lose a meaningful chunk of those gains to taxes. Not because of a mistake, just because of timing. Capital gains taxes don't have to derail a well thought out investment plan. And that's exactly what we're going to talk about today. Some lawful strategies that will help you keep more of what you've built working for you. Before we get into specific strategies, it's worth understanding the broader concept. A tax shelter. At its core, a tax shelter is a strategy available to both individuals and businesses that helps reduce what you owe in taxes by lowering your taxable income. Sometimes that means deferring taxes to a later date. Sometimes it means reducing them. And in limited cases, it can mean eliminating certain taxes altogether. The result in any of these scenarios is that more of your capital stays available for investing. Now, it's important to make a distinction here. There's a significant difference between appropriate tax planning and abusive or improper tax shelters. What we're discussing today falls firmly in the former category, lawful approaches that are widely recognized and used. These include things like deductions and tax credits, tax deferred retirement accounts, charitable giving, income shifting, and owning municipal bonds. Within real estate specifically, two strategies tend to get the most attention. Let's walk through both. The first is the 1031 exchange, named after its section of the tax code. A 1031 exchange allows an investor to defer federal capital gains taxes by reinvesting the proceeds from the sale of investment or business use real estate into another qualifying like kind property. This is not a new concept. The provision dates back to 1921, and it enables investors to continue buying and selling real estate without triggering immediate tax liability at each transaction, essentially allowing you to keep compounding without pausing to write a check to the IRS each time you move from one property to another. That said, the rules are strict and highly procedural. Two of the most critical deadlines to know: one, whose place in properties must be identified within 45 days of the sale. Two, the purchase must be completed within 180 days with proceeds held by a qualified intermediary throughout the process. A 1031 exchange defers taxes, it does not eliminate them. Think of it as kicking the can down the road. But by keeping more capital invested rather than paid out in taxes, investors may benefit from greater flexibility and the potential for more efficient long-term compounding depending on market conditions and the specifics of each transaction. The second strategy is opportunity zones, or OZs, created under the Tax Cuts and Jobs Act of 2017. They were designed to encourage long-term investment in designated economically distressed communities across the country. Here's how it works. Investors may reinvest capital gains from the sale of nearly any asset, a business, a stock, real estate, into a qualified opportunity fund, commonly called a QOF, generally within 180 days of realizing the gain. By doing so, investors may be able to defer federal capital gains tax on money they've already made, keeping more of that capital at work rather than paid out in taxes. The original deferred gain is eventually taxable. However, this approach can provide meaningful current cash flow and flexibility around timing and liquidity. Here's where it gets particularly interesting. If you hold the opportunity fund investment for at least 10 years, any appreciation on that investment, the growth within the fund, may be exempt from federal capital gains taxes when sold, subject to applicable rules and elections. It's very important to note this benefit applies only to the growth of the opportunity zone investment, not the original deferred gain. That said, opportunity zone investments are typically long-term, illiquid, and higher risk. Results depend on project performance and regulatory compliance. This is not a strategy for everyone. Both of these strategies involve meaningful complexity. Rules can change, risks matter, and each approach can affect things like estate planning, succession planning, and liquidity needs in ways that aren't always immediately obvious. That's why it's worth taking a step back, looking at the big picture, and relying on thoughtful analysis and professional guidance to determine whether any of these strategies truly fit into your overall wealth plan. At Hightower Westchester, that's the kind of conversation we have with our clients every day. Not just optimizing for returns, but thinking through the full picture. If that's a conversation you're ready to have, we're here. Thank you.